This is VeriScope News. Verified news, clear context. Oil markets opened the week with limited movement. Prices were little changed in early trading. Recent gains slowed as the market weighed opposing forces. On one side, harsh winter weather disrupted U.S. oil production. On the other, broader supply conditions continued to cap price gains. This report explains why oil prices stabilized. It outlines current production disruptions in the United States. It reviews supply developments in other regions. And it explains how traders are assessing risks going forward. All information in this report is based on publicly available data. The focus is on facts and context. Let's begin with what happened in the market today. Oil prices often respond to changes in supply rather than demand alone. Short-term disruptions can move markets quickly. Longer-term expectations can limit those moves. In recent sessions, oil prices rose more than 2%. Those gains reflected concerns about supply interruptions. Much of the focus was on the United States. Winter weather disrupted oil production in key regions. Cold temperatures and storms forced temporary shutdowns. Output declined in several producing areas. At the same time, global supply conditions remained mixed. Some regions returned capacity after maintenance. Others continued operating normally. This combination created a balancing effect. Supply disruptions supported prices. Broader supply availability restrained them. Markets entered the new week weighing these factors. The result was limited price movement. Understanding this balance is key to today's story. According to Reuters, oil prices were little changed on Monday. This followed gains of more than 2% in the previous session. Brent crude futures slipped slightly. They traded at $65.81 a barrel in early Asian hours. That was down 7 cents from the prior settlement. U.S. West Texas Intermediate crude also edged lower. It traded at $61.01 a barrel. That marked a decline of 6 cents. Despite the modest pullback, both benchmarks remained elevated. They closed last week at their highest level since mid-January. Weekly gains totaled about 2.7%. The market focused on supply disruptions in the United States. Harsh winter weather reduced output in several regions. Analysts at J.P. Morgan estimated that about 250,000 barrels per day of crude production were lost. Declines were reported in the Bakken region. Output was also affected in parts of Texas and Oklahoma. Winter storm conditions forced producers to shut in wells. Power grids came under additional strain. Natural gas production was also disrupted in some areas. These disruptions tightened physical oil flows. They helped support prices following last week's rise. At the same time, broader supply conditions limited further gains. Some overseas supply issues eased. This offset part of the U.S. disruption impact. As a result, oil prices stabilized rather than extending their rally. Oil production is sensitive to weather. Cold temperatures can freeze equipment. Storms can halt transportation and power supply. In the United States, winter storms frequently affect oil-producing regions. Shut-ins are often temporary. Production typically resumes once conditions improve. The Bakken region is particularly exposed to cold weather. Extreme temperatures can reduce output quickly. Recovery depends on infrastructure and access. Texas and Oklahoma also face weather-related risks. Ice and snow can disrupt drilling and transport. Power outages can slow operations. While U.S. disruptions attracted attention, global supply remained relatively stable. Producers outside the United States continued operating. Some regions even restored capacity. One example came from Kazakhstan. The Caspian Pipeline Corporation reported a return to full loading capacity. Maintenance at one mooring point was completed over the weekend. This helped restore export flows through the Black Sea. The development reduced pressure on global supply. Markets also considered longer-term expectations. Some analysts continue to see ample supply in the years ahead. This outlook limits how far prices can rise on short-term disruptions. Traders balance immediate outages against broader fundamentals. Temporary losses matter, but long-term supply projections still guide pricing. This explains why prices stabilized rather than surged. Oil prices influence the global economy. They affect fuel costs. They influence transportation and production expenses. They also shape inflation trends. When prices rise sharply, costs can increase for businesses and consumers. When prices fall, revenue declines for producers. Stable prices reduce uncertainty. They allow companies to plan operations more effectively. They help governments forecast energy costs. Today's price stability reflects a market absorbing disruptions. It suggests that current outages are viewed as temporary. For producers, this environment highlights operational risks. Weather remains a key factor. Infrastructure resilience matters. For consumers, steady prices can help moderate fuel costs. Sudden spikes were avoided in this case. For investors, oil prices serve as a signal. They reflect supply conditions and geopolitical developments. They also influence currency and equity markets. The broader takeaway is balance. Several factors could influence oil prices in the coming days. First, the duration of U.S. production disruptions. If winter conditions persist, outages could continue. If weather improves, production may recover quickly. Second, overseas supply developments. Any new outages or maintenance issues could shift balance. Continued smooth operations would ease pressure. Third, producer policy decisions. Markets remain sensitive to signals from major producers. Any changes in output strategy could affect prices. Fourth, geopolitical developments. Tensions in key regions can add risk premiums. Markets monitor these closely. Finally, demand indicators. Economic data may influence consumption expectations. Seasonal trends also play a role. Together, these factors will shape price direction. Oil prices were little changed as markets weighed competing supply forces. Winter weather disrupted U.S. production. About 250,000 barrels were temporarily lost. This supported prices following recent gains. At the same time, broader supply conditions limited further increases. Some overseas capacity returned. Longer-term supply expectations remained intact. The result was price stability. Neither buyers nor sellers gained control. This balance reflects how oil markets process short-term disruptions. Temporary outages matter, but long-term supply projections still guide pricing. That concludes today's report.